Hi, welcome to Trendy Options. Today we're going to be talking about the line in the sand. Acronym used in the room is LIS. What it looks like on my screen, how it works, where it's derived from, and most importantly, how we trade it. Let's go ahead and get started with what it looks like on my screen. That way you can familiarize yourself with it when looking at my charts in the morning and so forth. So the first thing you will notice, it's a beautiful one-liner, just one blue line. The line in the sand is created at the close of the day. It is not a cash close. It is not the close on the day. It's built around a candle structure. And again, it is a blue line and has the acronym LIS attached to it. Every new one has this. And you'll see this mainly in the futures channel. And then I'm going to give you an idea of what it looks like on equities and how we use it on the equity side. Now, I will tell you, when I first started using the line in the sand, it was meant to be just for futures. And then I found the power of using it with the rest of our scripts, which you'll be watching when we learn about the PMZ and we learn about the edges and so forth. But let's talk about why it works. I think that's probably one of the most important things about the line in the sand, because a lot of traders, when they first see just a line on the screen, it's very difficult for you to get behind it, right? I mean, I can give you the methodology, but if you just see this line, you're like, why would I go short there? Why would I go long here? Well, I'm going to explain that to you. So when the market closes, let's say that the market is going down, okay? And it's getting closer and closer and closer. And then right before it closes, it does close, but then it settles on the futures and you create this pivot right here. Okay? And then you get this blue line that's called the line in the sand. Because of that pivot and because we were going down, we create what's called supply. And then on the other side of things, we are moving up. Price jolts, we close. Price settles, we create a pivot. We create demand. So in this scenario, let's say that we were to gap up tonight. We have created demand down here. So we'd like to wait for price to come back down into this pivot or demand, and we wait for a couple things to happen. Let's go ahead and talk about this really quick. So I'm going to zoom in here. What we like to see, and just like you're going to learn about the PMZ, sometimes we front run, sometimes we don't. What I'm looking for is a simple pattern off of the line in the sand. I'm looking for a move like this, a move back, and a higher high. This is when price is above the line in the sand. Sometimes price will come down immediately into the line in the sand. And if I were to take it immediately instead of waiting for this candle structure, I am front running my system. Let's say in futures, when I see a pattern like this, right there, I typically would buy 2 contracts, okay? So let's just write that out really quick. 2 contracts here. And then if I were to front run the system, okay, and not wait for the pattern to happen, then I could buy 1 contract. Now, why am I doing that? Well, because I have to have some rules around how I approach this situation. This has a higher probability of working out for me. This has a lower probability of working out for me. So if I take 1 contract and I use the same risk, I lose less money. Over here on a high probability trade, I'm willing to lose or win or willing to lose my full amount here because I have a higher probability is going to work out for me. Now that's not saying, right, the whole entire market is moved around probabilities. It could be that this week alone, that this structure that I'm showing you here works out better than this structure here. And then 2 weeks, this one does not work, and only this one works. Either way, I have a system in place to say, hey, when I front run it, I'll do one contract. And these are hypotheticals, folks. And if it does give me the right structure, then I'm going to take two. And let me backtrack on that. When I say hypotheticals, I mean with the numbers that I'm using. It could be 10 contracts, could be 20. Just depends on the person trading. Okay. So I'm looking for this structure, okay? And what would negate this structure? Well, let's say it's starting to look pretty good. It's doing something like this, but it closes down. This would negate that, okay? Then we would be looking for a lower low and perhaps get short off of here with a stop below there. And then, of course, I give you targets, okay? And you can see those here on the screen. So again, to the upside, we're looking for a break, a base, a higher high. We're looking for a drop, a base, and a higher high. And if I front run it, I'm only going in with half or a quarter size of my position. Just depends on your risk tolerance. Now, let's talk about it from the upside. So this is today's action off of the line in the sand. You could see that this worked very, very well. In your next video, you'll be learning about the PMZ and look at the amazing results from the PMZ, out of the PMZ into targets that were given to you in the room. And then also look at the beautiful rejection off of the line in the sand when we're below it. So just like you learn in trendy edges, when price is above the list, we look for it to be support. When price is under the list, we look for it to be, you guessed it, resistance. As you can see here, resistance, 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 resistance. Never did price close above or build the structure that I just taught you about. So let's say we're going short here. What would be your stop? Well, for me, in most cases, my stops are no larger than about 2.5 points. And that's really stretching it. I typically like to do 1.5 to 2 points or so. Okay, so I'm looking to get short when price is underneath the line in the sand. Okay. Now, what are we looking for our structure? Now, I will tell you, just like I was showing you before, this right here, there was no candle structure. This would have been front running the system. This would be a one contract or whatever it is to you. In this case, too, one contract. In this case, maybe two, because we actually got the structure here a little bit. We have the break candle. So sorry, this candle broke. We get the test from underneath and we make a lower low, and that's where your signal comes in right here to get short. Two contracts, and then we're looking for these targets that are given to the downside. Okay, so once again, these are looking really nice. This is how we trade it from the downside. So what does that look like? Let's just draw it one more time so that we have it correct. Now, if price is moving up and then the base is underneath, we are looking for a lower low. This is our signal to go short with a stop above. Or we could simply go short right on the test. And because we are front running the system and we are not waiting for bases or lower lows, I could just trade one contract here. Same result, but risking less money because I'm front running the system. Now, that's how we use this in futures. Let's go ahead and go over to our equity side, and we're just going to randomly pick a stock so that we can see the results. Okay, so let's look here. We will pull up Lulu, and we actually traded this today as well. And here we are. Let's go ahead and zoom in a little bit. All right, so here we are on the line in the sand. This is the line in the sand for today, which is Wednesday the 16th. You can see that price broke out of the PMZ, and again, you will learn about the PMZ. And because price was underneath, you can see that it was resisted here at the line in the sand. Now, when you start to put these together, you will have the line in the sand, the PMZ, and the edges. When we break out of the PMZ, especially on a gap down, we're looking for a move into the line in the sand. When the PMZ is up, see, notice this one's red and this one's green. This means we gapped up. When the PMZ is up and we break down, we look for the targets that are given to us, but also we look for the line in the sand to be a target. Not only does this work very, very well, it also serves as a target or an area where we look to get short or an area where we look to get long. And that's how the line in the sand works. Let's go over to one more example. Somebody in the room here today traded CMG. Let's go ahead and take a look at what that looks like. Okay, you can see here that price broke down below the PMZ, flushed through the line in the sand, but once it made its way back above the VWAP and EMAs, and you'll learn about that in the PMZ, we look to go long into the line in the sand, where you can see this was rejected. This is just one example. There are many examples of continued success using the line in the sand with not only futures, but with equities. Now that I've shown you what the line in the sand is, where it's derived from, what it looks like on the screen, I hope you now can understand and have a better understanding of why the line in the sand is so important. Don't forget the rules around it if you decide to front run or if you decide to wait. You should have rules when trading. And understand that the line in the sand really can change your entire trading strategy, and it also serves as a target. Thank you and have a nice day.